Hey, Steve Saretsky here. Welcome back to the show. A lot to touch on this week. We had another large movement in global bond yields. We've got an update to Canada's economic growth, as well as some housing stats, some things that I'm watching, particularly here in Vancouver, obviously, where I'm focused on a day-to-day basis in the housing market. But you have to start this week off. We did last week's video. We chatted about mortgage rates closing in on 7%. If you're looking for a 1-year mortgage, you're already north of 7. If you're looking for a 2-year fixed rate, you're bumping up around 7% right now. The all popular 3-year mortgage is around 6.5%. And so these are very, very important numbers. Again, particularly when you start looking at the ability to qualify people. So you have someone that says, hey, listen, I don't want to lock in at 5 years because these are the highest rates we've seen in 15 plus years. So I want to go to shorter duration, 1-2-year term, and look at playing a potential fall in bond yields and mortgage rates. Well, guess what? If you go 1-year fix, 7.25%, you're getting stress tested at 9.25, and all of a sudden you don't qualify for a whole lot. So this is the problem facing the housing market, and it seems like every day this week in particular, as well as last week, you wake up, you look at bond yields, and they're higher on the day, and then you wake up the next day and they're higher on the day. And so this is really the ongoing problem. The bond market is doing the tightening for the central banks, for the Bank of Canada. So even if the Bank of Canada doesn't raise rates at their next meeting on October 25th, the bond market is doing it for them. It is moving yields higher and tightening financial conditions. And so this is, again, something that you have to watch on moving forward, and as part of the overarching thesis. Again, the Canada 5-year bond yield, which prices your 5-year fixed mortgage rate, is up about 50 basis points over the last 2 weeks. I mean, that's a massive, massive movement in the bond market. Now, I'm going to sort of touch on some things that I think could potentially at some point start to change that dynamic, but this is ultimately what's driving the bus on the housing market right here, right now, is rising mortgage rates and the inability of people to qualify. And so, as you see yields pushing higher, obviously you think about the indebted economy, particularly that we have here in Canada. Global debt to GDP is 365% of GDP, all-time record highs. In Canada, one of the most indebted private sectors in the G20. And so as yields rise, the economy slows down. We're seeing, consumer confidence just this last week rolling over to levels that we've last saw during the depths of the pandemic. Business confidence, that business confidence index, again, rolling over to levels last seen during the depths of the pandemic. And so, again, as consumer and business confidence goes down, what happens? You tend to spend less money. You tend to be a little bit more nervous in your business. You're probably looking at, you're certainly probably not looking at hiring new people. You're probably delaying CapEx projects. And so spending in that sector starts to slow down. So obviously confidence drives a good chunk of the economy and people's decision making. And so as that consumer confidence rolls over, we're seeing, again, it's kind of coinciding with economic growth. And this is something I've talked about. I think we put out a video 3-4 weeks ago saying, we're at a pivotal point in time for the Canadian economy as we're going to start to see these important data points rolling over. And that was 3 or 4 weeks that we've been, talking about this. And I think we got an update this week. We got the updated GDP figures here for, I believe it was the month of July. They did a nowcast for August, also looking weak, but the numbers came out for July. And so if you look at it, this is per RBC. They're saying controlling for population growth, right? We added over 1 million people in this country over the last 12 months. That's the largest growth rate this country has seen since 1957. So these amount of people can obviously distort the statistics in this country. We call it, human QE, basically paper overing a lot of the issues in this country. And so controlling for population growth, Canadian GDP has contracted for 4 straight quarters on a per person basis, including a 3.5% annualized per capita decline in Q2. And I mean, these numbers are staggering. I mean, 4 consecutive quarters of declining GDP per capita in this country, and people are talking about, no landing. I'm hearing soft landing, but certainly no talks or discussions around What about a potential hard landing? So remember, that's becoming more and more of the base case. Now, what I want to emphasize is that you're seeing all this, right? 4 straight quarters, and the legs from monetary policy have not even fully filtered through. It takes up to 18 months for rate hikes to sort of filter through the system. And so these are still working through. I mean, one of the charts you can look at is you can go and look at the implied average mortgage rate, which is posted by the Bank of Canada, currently showing about 4.3% here in Canada. So saying the average sort of household is seeing about a 4.3% mortgage rate. And again, the typical 5-year fixed mortgage rate today sits about 6%. And again, if you're going shorter duration, of course, it's higher because you've got that inverted yield curve. And so there's still a lot of this that has to filter through. You think about people that have, renewed their mortgage this year or coming up for renewal, they're just about to renew at 6.2, 6.3%. And they're just going to start seeing those payments, right? So maybe they've only had a month of 6%, 2 months of 6%. They haven't had 5 months, 6 months, 8 months, 18 months of 6% mortgage rates, because that's going to be the reality of this monetary policy sinking through the economy. And it's not just, households, it's obviously businesses that are borrowing money on lines of credit or debt that is rolling over, that is maturing. And so, monetary policy hasn't fully worked its way through, and you're basically seeing, again, I would call it, a recession in Canada. And again, you can have population growth numbers that paper over a lot of that, but the reality is I think the country is already in a recession, and I would call it a very, very soft recession. But the longer that rates stay elevated at these levels, we do tiptoe towards a harder landing. And I think that, like I said, I think that's becoming more and more of the base case. And I'm just looking here, again, now slowly starting to see this filter through into the housing market. We've talked about people's rate holds expiring, and obviously there becomes less of an incentive to then pull the trigger on purchasing. So looking at some of the early data here, you're watching this video as of the end of September, looking at the Vancouver housing data. It should come in about 25% below the long-term 20-year average. So if I go back and say, okay, show me the last 20 years of home sales in the month of September, and how are we sort of lining up for September of 2023, we're about 25% below the long-term average. Again, even adjusting for, this isn't adjusting for the population growth that we've seen in the city as well. And so this is what we're seeing, hearing it anecdotally in Toronto. The Toronto numbers might even look worse. And so this is what's happening in some of our major metropolitan cities. I can tell you that on the new listing side, new listings, for the good chunk of this year, we're running at pretty much 20-year lows for most of this year. For the month of September, we're seeing it running slightly above the 20-year average. So new listings have now, again, it's only 1 month, so take it with a very small grain of salt, but for 1 month, what we're seeing is, okay, sales down quite a bit, sales weak, which they've been pretty weak throughout all of this year. Sales down, new listings finally getting not just above 20-year lows, but back above trend line of what you'd expect over the last 20 years. And so this is obviously going to shape up into a situation where, okay, finally we can rebuild inventory off of its record low base. So the inventory can slowly stagnate, sit on the market longer, slowly allowed inventory to build as sales remain weak, and as new listings keep coming on, that slowly allows the inventory to build. As the inventory builds, of course, sellers slowly but surely reduce prices. And again, keep in mind, house prices are incredibly sticky, as we've experienced for many, many years, right? It's like you think about a home seller that lists a property on the market. They put it on at their price. It's always their price. And everyone's psychology is, everybody thinks their house is worth more than it really is. I don't know if I've ever met a client that hasn't thought that way. And so it's always, okay, here's my recommendation for a price, but you want to start here. Okay, let's start here. You're the boss. And then what happens is it sits there for 3 weeks. Then you look at doing the price reduction. It might sit there for another couple of weeks. Then you're doing another price reduction. But what can happen in this changing housing market environment is that every reduction, you're one step behind the market, right? So it's like if you sit on the market for 4 weeks and then you reduce, well, the chances are the market's already slowed further over those 4 weeks. And so you're just basically playing catch up, chasing the market lower. And so I think this is a realistic scenario for a lot of home sellers heading into the back half of this year. Expecting anything is going to change in the back half of this year, I think, is naive. I think the writing's pretty much on the wall. October, seasonally, you're going to get seasonal uptick typically in sales and new listings. I don't know if we're actually seeing that uptick in sales, but certainly starting to see it in listings, allowing inventory to build. And then you go into the historically quiet months of November, December, January. If you're a home seller looking to sell, you might be waiting until mid-February, the start of next year's spring market, to get your next opportunity to really sell in what is normally a better market. But again, to try to predict where conditions will be in February, March of next year is anyone's guess. It really just depends on the trajectory of mortgage rates, inflation, and the economy, right? I mean, because one way that we can get rates down is the recession, but that could involve, again, potentially hard landings where people lose jobs, which isn't necessarily a bullish setup either. So there's a lot of dynamics at play. I think there's a lot of risk out there. You have to sort of understand too, I get this question a lot, where's the risk? Where's the risk? I can tell you what we're seeing right now is you're seeing, actually, ironically enough, one of the strongest segments of the market. It's the luxury market. The luxury market is doing pretty good. Why? Because people that are buying $5 million homes, $8 million homes, $12 million homes here in Vancouver, they're not looking at financing. They're not borrowing 80% loan to value at 6.5% mortgage rates. Where you're going to see the stress and the pain is, think about where is the average person, where is the blue collar individual, and where can inventory build? Well, it can build in suburban markets, townhouse markets where you have a propensity to add density and add supply, investor units that are negatively cash flowing. You can add supply in there relatively quickly. The buyers of those, junior 1-bedroom units or 2-bedroom condos are typically, not only selling to investors, but they're selling to just normal day-to-day people that are, their borrowing went from 2% to 6.5%. That's going to change what they can qualify and what they can afford to buy. And so that's where you're going to see more of the sensitivity, is basically what went up the most over the last 3 to 5 years, and who's the buyer? Who is the buyer? Is the buyer a, wealthy downsizer type of market? Is it a wealthy offshore investor type of market? Or is it a local, hardworking blue collar market? And if it's the local hardworking blue collar market, that is the most susceptible to the change in the cost of money. So again, I hope that kind of illuminates a picture for you of sort of how to progress here moving forward. As we enter, again, the back half of 2023, and as the pivotal data starts to filter through, again, I think we're slowly now starting to see real economic weakness that is finally actually showing up in the data. And as we've talked about many, many times, the data always lags. So, as always, hope that helped. See you next week.